Have you noticed the stock market taking a nosedive lately? If you've been watching your investments closely, you've likely felt the sting of the recent declines. But before you start panicking or making rash decisions, let's dive into what's really going on. Understanding the key drivers behind these drops can make all the difference in how you navigate the storm. So, why exactly is the market down and what should you do about it? Stick around because we're breaking it all down for you. The S&P 500 recently experienced a 3% drop, marking the steepest decline we've seen in 2 years. This kind of dip might seem alarming, especially if you're new to investing or not used to seeing your portfolio in the red. But let's get one thing straight, market drops are a normal part of investing, even when they feel like a roller coaster. What's crucial is to understand why this is happening and what it could mean for your financial strategy. One of the biggest triggers for this market dip is the growing fear of a recession. When there's even a hint that the economy might slow down, investors start to react, and not always rationally. It's like a chain reaction. Worry sets in, stocks are sold off, and prices tumble. However, it's important to remember that not every market dip points directly to a recession. Instead, it's a reflection of investor sentiment, which can often swing from one extreme to another without clear economic justification. Let's talk about the job market. Recent data shows a slowdown in job growth paired with a rise in unemployment. On the surface, these numbers might look concerning, but they don't necessarily scream recession. Lower job growth and rising unemployment can cause market jitters, but they're just one piece of a much larger economic puzzle. The truth is, we're not in full-blown recession territory, at least not yet. Now, you might have heard whispers about the Federal Reserve cutting interest rates. While it's easy to interpret this as a signal that things are dire, that's not always the case. The Fed often adjusts rates as a proactive measure to keep the economy balanced. Think of it as fine-tuning, rather than an emergency response. Lower rates can make borrowing cheaper, encourage spending, and ultimately support the market. So, while the headlines might paint a gloomy picture, remember that these moves are often about maintaining stability rather than reacting to a crisis. Another factor adding fuel to the fire is the overvaluation in tech stocks, especially those driven by the AI boom. Tech stocks have been riding high for a while, but rapid growth often leads to corrections. It's a classic bubble scenario. Prices soar on hype and optimism, but when reality sets in, corrections can be swift and harsh. If you've been heavily invested in AI-driven stocks, it's a good time to evaluate your exposure and make sure your portfolio is diversified enough to weather these ups and downs. Global currency impacts. It's not just domestic issues stirring the pot. Changes in global currencies like the Japanese yen can ripple through markets worldwide, affecting stability and investor confidence. For example, when the yen fluctuates, it can signal larger shifts in global finance that make investors nervous, leading to more market volatility. It's a reminder that markets are interconnected, and international factors can have just as much impact as what's happening at home. Long-term perspective and investment strategy. So, what's the big takeaway? While market downturns can be unsettling, they're also a normal part of the investment journey. Instead of seeing a dip as a loss, consider it an opportunity. This might be the time to buy the dip if you have a solid emergency fund and are in a stable financial position. Buying when prices are down can position you well for when the market rebounds. Remember, the goal isn't to time the market perfectly, but to have a strategy that lets you take advantage of these natural cycles. Patience pays off. Here's the bottom line. Patience and perspective are your best friends during market turbulence. The stock market is a long game. While it's easy to get caught up in the day-to-day fluctuations, historical trends show that markets tend to recover and grow over time. The key is to stay calm, stay informed, and stick to a plan that aligns with your financial goals. Don't let the headlines dictate your strategy. Instead, focus on the bigger picture and remember that every dip is part of a larger upward trend. Conclusion: navigating market volatility isn't always easy, but it's a crucial part of investing. By understanding the underlying factors, whether it's economic data, Federal Reserve actions, or global influences, you can make more informed decisions and keep your investments on track. So the next time the market takes a dive, take a step back, breathe, and remember, this too shall pass. Keep your focus on your long-term goals and let the market do what it does best. Move through cycles. Stay smart, stay steady, and your financial future will thank you.